Hello and welcome to the Caledonia Mining Results Call. My name is Dan and I will be your coordinator for today's event. Please note this conference is being recorded and for the duration of the call your lines will be on listen only. However, you will have the opportunity to ask questions later on in the call. If you require assistance at any time, please press *0 on your telephone keypad and you will be connected with an operator. I will now hand you over to Steve Curtis to begin today's conference. Thank you.
Thank you, Dan, and welcome everybody who's joined this call. You are aware that this is the 2020 results presentation for Caledonia Mining. The presentation in graphic format is on our website. And also there is a recorded presentation by Mark and myself that you can also view on the website if you want to get more detail. So we'll go briefly through the key points and then we'll open this up to Q&A. I'm joined on the call today by Donna Roots, our COO, Mark Learmonth, CFO, Maurice Mason, who's in charge of business development, and Camilla Horsfall, who is in charge of our investor relations. So the whole team will be available to take your questions, and we look forward to a constructive call. So just starting off, drawing your attention to the usual disclaimer, and you're all aware of its need and content. I'll just quickly briefly talk about the highlights, and then I'm going to hand over to Mark to go through the financial side of the presentation. And as I said, Donna is available to answer any operational questions that you may have that will take place during the Q&A. So really, the 2020 highlights, of which we're very proud, is that from a health and safety perspective, we went through the year with COVID. It had very little effect on the operation at Blanket Mine. Management did an extremely good job in protecting our workers, and we had virtually no effect on the overall production levels. And as we have announced before, we actually came out with a record annual production of nearly 58,000 ounces for Blanket, which under the circumstances is just fantastic considering the lockdowns that had to take place. The operation was also run at a very well-controlled measure from a cost perspective, although there were some additional and incidental costs associated with COVID, and Mark will go into those in a little bit more detail. But the four really key highlights that you're probably familiar with already, because it was in the press announcements that we made. We hit 100 million turnover as we are in a higher gold price environment. That was a 32% increase. Gross profit came up to 46 million, and that was a 50% increase on the previous year. And adjusted EPS came in at 204 cents, just over $2, a 41% increase. And all in all, because of the strength of the business, the strength of the gold price, and our confidence in what the future looks like, we have been able to increase the quarterly dividend 4 times during the year of 2020. Which has given us a cumulative increase of 60% from late 2019 through to late 2020. So from a shareholder perspective, we have generated value, we've shared some of that value, and we are demonstrating our confidence going forward. The outlook, which is critically important to that ability to increase the dividend. The Central Shaft, our confidence is high because Central Shaft was fully equipped during 2020, and commissioning will take place during this quarter, and it will be completed during the period of the first quarter of 2021. Our target production this year is going to be 61 to 67,000 ounces, as we've mentioned before. and then we will get into the ramp-up of 80,000 ounces from 2022 onwards, which has been our guidance for the last few years. So despite COVID, we have managed to stick to that goal. We've managed to deliver the shaft, and for that, we are very, very proud of our teams that we've had down at the Blanket Mine. And most importantly, we have also put into action our talk about wanting to expand our portfolio of assets, and we announced late in 2020 that we had acquired the options over 2 new exploration properties, brownfield properties, and we are starting to mobilize on those properties. One of them has got drill rigs on it. The other one is still in the planning stage. But we're very excited that we are now embarking on the next phase of Caledonia's development. So those are the highlights. We're very proud of them. And I think now what we should do is hand over to Mark and ask him to go into the financials in some detail, and then we'll take your other questions on matters of interest to you when the team will be available to you at the end of the call. So Mark, if you'll take it from there, please.
Thank you, Steve. So the financial review section starts on page 12 of the presentation that's loaded onto our website. So page 13 gives the results highlights. As Steve mentioned, revenue was up to 100 million, and as you can see, that was due to a 5% increase in production and a 27% increase in the average gold price. Steve's already mentioned gross profit up by 50%, adjusted attributable profit up by 55%. Adjusted attributable profit, all we do there is we strip out things like foreign exchange gains in particular, also losses, and profits and losses arising on the disposal of non-core assets. So we're really trying to get to the core performance of the business. So we genuinely do believe that 55% reflects the performance of the business. Just looking at the profit and loss accounts on page 14, revenue I've dealt with, the royalty stays at 5% of revenue. Production costs appear to go up quite significantly. They go up by 20%. That does include a substantial component of what I call non-controlled costs, and I'll come back to that in a moment. Similarly, G&A increases by 43% from 5.6 million to 8 million, and I've got some more context on that shortly. The net foreign exchange comes down. Last year in 2019 it was nearly 30 million. This year it's 4.3 million. And that doesn't reflect any diminution in the rate of devaluation of the Zimbabwe dollar. It just reflects the fact that in 2019 we devalued some very large liabilities down to not very much, and simply there's not much further for them to go. So that's the reason why the foreign exchange gain was smaller. And other in 2019 was a gain of 3.9 million. This year it's a loss of 2 million. In 2019, that 3.9 million, most of that, 5 million of that was a profit on the disposal of the Esling gold mine in South Africa. In 2020, that reversed. We incurred a $2 million impairment on a small exploration asset, which we decided to get rid of. And that 2020 also includes $1.4 million of equity settled share-based payment expense. That's a long-term incentive award to management and employees. The bulk of that value is driven by the higher share price. I'll come on to tax in a minute, but the tax rate of 15.2 million at first blush seems to be quite a high effective rate, and I've got some further context on that in a moment. So turning to page 15, production costs, wages and salaries up by 16%. That reflects a 12% increase in man hours worked, and the balance would be higher per capita payments. It's fair to say in the year we put in a much more aggressive bonus structure, and as Steve's already mentioned, in the year performance was a record, and so it's not surprising that the workers are rewarded for that success. Consumables also goes up 15%. That's largely due to the increased cost of maintaining the fleet of trackless equipment underground, which mainly work in the declines. We have had difficulties with maintaining that equipment. The stuff we bought initially was reconditioned second hand, and it did have a high maintenance cost. We've done 2 things. We've replaced much of that equipment with new equipment, and also we've taken on a specialist contractor to help us improve the the maintenance scheduling of that equipment. So we believe we've got our arms around that. Then offsetting that increase was a reduction in the cyanide usage as a result of the commissioning of the oxygen plant in March. Nearly $800,000 worth of COVID expenses. That's PPE and stuff like that, which is unavoidable. The ZESA electricity costs, ZESA being the grid provider, that went up from 5.9 million to 6.5, and that reflects a 12% increase in power usage, and that also is due to a 7% increase in tons milled. We also saw a substantial increase in the cost of electricity, diesel to run the gensets. That went up from $500,000 to 1.8. So that effectively means the hours used increased from 3,800 hours in 2019 to 8,500 in 2020. And that increase informed the decision we took in the middle of 2020 to press ahead with a solar project, because frankly we can't see the electricity situation in Zimbabwe or Southern Africa generally improving, and it's probably more likely to get worse before it gets better. So as a defensive maneuver, we decided to press ahead with solar. And at the mine, in addition to the $1.4 million of share-based payment expense I've referred to at the group level, at the mine there's a smaller amount, $0.6 million of share-based payment expense in respect to those employees at the mine who participate in that scheme. And as I say, that charge is largely driven by the movement in our share price. So that's total IFRS production costs increased by 20% from 36.4 to 43.7. But within those costs, there were quite substantial costs that I would call non-controlled costs. So in 2020, there's about 3.3 million of such costs, being the cost of the COVID consumables, the cost of running the gensets. When the electricity goes down, we have the choice of either running the gensets or not producing, and clearly we prefer to run the gensets, and also the share-based expense. So if you strip those out of 2020 and 2019, the increase is 16%, from 34.9 to 40.5. And if you express those values in terms of cost per ton, the cost per ton increased by 8% from just less than $63 an ounce to $67.60. And frankly, with anything much less than 70, we're very pleased with. Anything much less than $70 an ounce, $70 a ton, we're quite pleased with. So whilst the headline number seems to have increased, we actually believe that the core costs have been quite well controlled. Looking at G&A, certain costs went down, so in particular the investor relations cost went down and the travel cost went down, and that's largely due to COVID restrictions on travel and the IR events in which we participated. Advisory service fees increased by about $500,000 from 400,000 to just over 900, and that reflects quite a lot of work that we had to do in the course of 2020, on things which we later got value from. So we incurred legal fees in respect of the TSX delisting. But we're very confident that the TSX delisting actually increased our overall liquidity in North America. So if you compare liquidity on the Toronto Exchange, the New York Exchange for the 6 months before we delisted, with the liquidity on the New York Exchange after we delisted, I think it doubles. And one of the difficulties we faced in recent years is low liquidity. So we're very pleased to increase the liquidity. We also incurred fees on an SEC S3 filing, which we then subsequently used for the purposes of the ATM issue. And then we also incurred legal fees on the solar project for the period of time before we got board approval, and so we had to expense those rather than capitalize them. So those fees have gone up, and they do reflect a very high level of activity last year, but I hope you agree that those expenses flowed through into things for which we derive tangible benefit. Wages and salaries up by about $1 million. Part of that was due to an increased headcount, so we took on a senior geologist to help us improve our resource management and also begin to look at the new projects which we acquired. We took on a rock mechanic, so as the mine is going deeper, we now need to begin to pay more attention to rock mechanics, and we took on Camilla to do IR for us. It's also fair to say that as a result of the strong performance in the year, management did receive higher bonuses. A number that really sticks out is the increased liability insurance, which went up by nearly $1 million. That's the insurance premium for directors and officers cover. That hurt to have to pay that amount, but it does reflect a general very sharp tightening in the market for that sort of cover, as insurance companies are becoming increasingly concerned about recent problems in the mining industry, particularly related to things like slimes, downwall failures, and that sort of stuff. And to make matters worse, because our primary listing in terms of volume is now in New York, the insurers are more worried about class actions, which typically come from the New York market and not other markets. So I would like to see that come down in the future, but I think it will be substantially higher than the 86 that we enjoyed in previous years. Online cost per ounce, don't forget these costs per ounce, they do include these non-controlled costs that I've referred to previously. Turning to page 18, the overall tax charge of nearly 15.2 million, that reflects an effective rate of 37% of IFRS profit. But that doesn't tell the entire story. So the core of the tax is income tax and deferred tax in Zimbabwe. And if you add together income tax and deferred tax in Zimbabwe and express that as a percentage of IFRS gross profit, which approximates very closely to online profit, that gives you an effective tax rate of 27%, which is very close to the headline rate of tax in Zimbabwe of 25.75%. But then in addition to that sort of what I'd call core tax, we also incur income tax in South Africa on intercompany profits. And then we also incur withholding tax as we move money around the groups, as we move money from Zimbabwe to South Africa, and as we move money from Zimbabwe to the UK and Jersey. And clearly those money movements don't reflect profitability. So inevitably we will, as we go forwards, continue to incur those taxes in South Africa and the withholding tax. Cash flow, not much to say about that on page 19, extremely strong. Cash flow before working capital was over 42 million. We continue to see an absorption of cash into working capital, 4.5 million in 2020, 4.2 million in 2019. Part of that is just due to the erosion of supply credit in Zimbabwe due to the very high rate of inflation. But it's also fair to say that part of it was also due to an increase in the stock levels of inventories. And frankly, whilst for many years I've been trying to get the stock levels down, that did save us in the course of 2020 because we had to rely on the high levels of stocks of key consumables, cyanide, explosives, drill steels, and what have you, to keep the mine going when the supply chain up from South Africa to Zimbabwe was interrupted. Fair to say, last year we invested a lot, $28 million of capital investment in the year. That includes about the 2.6 million that we spent on getting our hands on the two new investment properties. As we move into 2021, we'll be spending even more because don't forget we'll also be spending about $13 million on the solar project, and then I'd expect capex to fall away very quickly from 2022 onwards. The net financing income of 7.3, clearly that's the net of 12.5 million of the net equity raise that we did in the summer, and $4.5 million of dividend payments. Balance sheet very strong. Again, I wouldn't say much about that. All I would point out is because there's now much more cash moving, we need more cash held in South Africa to act as a buffer because of the very high level of procurement spend in South Africa. That does mean from time to time we do hold surplus cash in South Africa. We're not allowed to hold that cash in US dollars. We must hold it in rands. And it takes a long time to get the money out and to get the money back in again. So rather than leave that cash exposed to rand devaluation, we're holding it as a gold ETF. So it means we can, if needs be, access that cash in South Africa at short notice rather than have to wait several weeks to get it back into the country if we need it. Steve's already mentioned the dividend. We started increasing in January 2020. We increased it from 6 and 7/8 cents to 7.5. We would probably have increased it again in April last year had it not been for the coronavirus thing. So as you recall, instead of declaring the dividend in early April last year, we decided to wait for 4 weeks to see how it played out. At the end of those 4 weeks, we were comfortable to maintain the dividend at 7.5. We didn't think it appropriate to increase it further. And then we increased it to 8.5 cents in July, 10 cents in October, and then further increased it to 11 cents in January this year. And the next dividend announcement is due very, very early in April. So that's all from the financials. Steve, I'll hand back to you.
Thank you, Mark. I'll just summarize how we see the outlook, and then we'll go into a Q&A. So just to reiterate, 2022, our target of 80,000 ounces is now very, very close, and it remains the absolute focal point of our business, and we really do look forward to ramping up production to achieve that target. The solar farm is very important to us, and that project is full steam ahead. Final designs have been signed off. The instruction to proceed has been issued. COVID has abated a bit in Zimbabwe, so the contractors will be able to get on site. So we're very excited about the solar project. It will take roughly 12 months. So this time next year, we will have a 12 megawatt solar farm providing nearly 27% of Blanket's power for its base load during daylight hours. The exploration projects, as we spoke about, become a more focused part of our business as we ramp up the gold production. It just, as I say, it just puts into action the words we've been saying for a while now, that we want to increase the portfolio of our pipeline. We want to move away from being a single asset producer, but shareholders must remember these are brownfield exploration. They will take their time, and we will conduct them in a responsible and professional manner. But we look forward to reporting back as and when we have something to talk to the market about. The other focus that Caledonia has in Zimbabwe, and it's a growing focus that we really are formalizing, is our commitment to ESG. We have got a solid CSR program on the ground where we work with our local communities to ensure that we make a difference in people's lives. We work very hard to adhere to the highest standards in terms of environmental behavior, our tailings dam management, the solar farm comes into that. So the ESG is something that we have done quietly in the background. Now we're bringing it to the fore, and you will see more and more about our efforts there. We have recently just added a new non-executive director to our board, who is going to have a focus on the ESG side of our business, because she brings many years, many decades of experience for other businesses in the mining space across a number of jurisdictions. So we look forward to being able to wave that flag quite a lot higher. Our outcome of the 80,000 ounces is obviously going to be increased cash flows. There will be lower unit costs coming out of Blanket because of the economies of scale. And as we get past 2022, there will be a slow reduction in the overall capex because the project for the South Sinking is completed. There will be some money spent on the plants just to increase our capacity there, but it's minor, and that's probably going to take place during 2021 and 2022. So that is an exciting time that the cash flows flowing up to Caledonia are going to start improving. As we get deeper into the mine, the new shaft allows us to get down to 1,200 meters. We will be able to do further deep level exploration, and that will enable our geological people to enhance our reserve and resource, replace ounces that we deplete. And at the moment, we have a life of mine that's up to 2034, and that may be extended, or at least it will be protected as we exploit 80,000 ounces a year. Dividends, there's going to be an announcement in the next couple of weeks about our next quarterly dividend, so shareholders should look out for that. But as we've said, we are confident. We have shown we are confident by increasing the dividend 4 times recently. And we have got to the end of a long and difficult and expensive program. So we excuse me, we look forward to talking to shareholders about dividends as we go forward. We will continue to evaluate other investment opportunities. So Glenhume and Connemara North are not going to be the only projects that we hope to put into the Caledonia portfolio. We will continue to look at other opportunities. We will have some surplus cash flow that we can deploy towards these assets. And as I say, we want to build Caledonia into a mid-tier gold producer with a portfolio of assets that diversify risk and potentially even diversify jurisdiction. So that for us is a very exciting part of the future of Caledonia. Blanket is secure. We've got a good business to build a solid platform on. And with that, I think I should close off and open up the session to Q&A, and you can have access to the rest of the team. So thank you very much for listening, and I'll hand back to Dan, and he can open up for the Q&A session.
Thank you, Steve. Ladies and gentlemen, if you wish to ask a question, you can press star 1 on your telephone keypad now. Please ensure your phone is unmuted locally so that I can call your name and advise when to ask your question. Again, that is star 1 on your telephone keypad if you wish to enter the question queue. And we do have some callers coming in. One more time, it is star 1 at any time to join the queue. But the first question will come from Howard Flinker. Howard, when you are ready, your line is now open. Please go ahead.
Hello, everybody. I have 3 minor questions. In the managerial commentary, does ECI refer to the now terminated governmental price support program for gold, or is it something else that I forgot?
Yeah, it keeps on changing its name, but that was one of its iterations, yes. Yeah,
okay. Second, I've read that, I guess I can put quotations around this, inflation in Zimbabwe is decelerating. What is the most recent guess at what annual inflation is?
It's several 100%, but it's still several 100%. But how that doesn't affect us because most of the stuff the mine uses we import anyway. So drill steel, cyanide, all that stuff's imported. We pay for our electricity largely in US dollars, and we pay our workforce in either US dollars or local currency. But the local currency component, we pay them an adjusted amount every month, which reflects the devaluation of the exchange rate. So we try to keep our workers level in US dollar terms. So inflation really doesn't affect us at all. Howard.
No, it affects the currency, but. From what you've read or what you've heard, is it still above, say, 200%?
Oh yeah, it's closer to 500. Yeah. But it is moderating slightly. But it's a wild goose chase. It just doesn't affect us.
Okay, no, I was just curious. And finally, next year, will there be any extra solar power in what may be off hours that you could sell to the national grid? Right. Or will you use the full capacity?
No, the whole point of phase 1 is that we will use the whole capacity on a use it or lose it basis. Phase 2 would be we would need to have an arrangement where we could deal with surplus power from time to time. Now, I'm not for a minute saying that we can't negotiate that, but that will take some time. And so the thinking was to get phase 1 up and running and prove the concept, frankly, and then we'll deal with phase 2 later.
Yeah, and then you'd have to negotiate a price satisfactory to Caledonia parent before you proceeded. Otherwise, it wouldn't be worth your while.
Yeah.
Okay, thanks. Stay healthy, guys.
Okay. Thank you, Hal. Thanks.
You're welcome.
And once again, ladies and gentlemen, it's star 1 at any time if you wish to enter the question queue. That is star 1 on your keypad. The next question will come from Michael Trilly. Michael, when you are ready, your line is now open. Please go ahead.
Hello there. Your gold output is bought by the authorities. What proportion of that is paid for in US dollars? And what proportion of your costs are in US dollars?
So currently we're paid 60% in US dollars and 40% in local currency. The 40% in local currency we use for local purchases. So at the moment we're paying for our electricity on a 60-40 basis, although there are ongoing negotiations about that. We pay our workers on a 60-40 basis. Just about most of the consumables are imported, and so we pay for those effectively in South African rand, so not local currency. So what we do is to the extent we would have surplus local currency, we participate in a weekly auction whereby we sell that local currency in return for US dollars. And so we are not seeing a build up at this stage of unwanted local currency. So I'm going to say the regime, the 60-40 regime, has increased the administrative burden on the finance team enormously, but we make it work. So they're not making life easier for us, but it is workable.
I have one further question. You obviously externalize your profits so you can pay dividends. How are you actually doing that? How is it done technically? It sounds like a very difficult process to do.
No, it isn't. So Blanket obviously receives its revenues in a combination of US dollars and local currency. Yeah. It spends that. It spends, so some of that money then it has to spend either local currency for local stuff or US dollars for imported stuff. It then have a profit. It has surplus US dollars. Those US dollars are externalized via the payment of a monthly management fee to our business in South Africa for services provided. Blanket buys pretty much all the consumables it uses from our business in South Africa, so there is a modest procurement margin on that. And then there's still money left over, and so that money is then distributed from Blanket up to our 100% subsidiary in Zimbabwe called Caledonia Holdings Zimbabwe. So that goes up as a dividend payment. And then CAZ makes payments out from CAZ to the UK either by loan repayments or dividends. So, I mean, that's what we do. It is complex. It is complex, and so the treasury management and dealing with the RBZ is probably within all the operating difficulties of the business. That is probably the biggest single operating headache. But we make it work, and we've made it work for many years, and that's how we can pay the dividend.
Just one final question. You talk about treasury management. Are there any foreseeable problems with that? As you said, it's worked well thus far, but do you see any problems with that on the horizon?
No, I don't. But having said that, we must all recognise that Zimbabwe is very unpredictable.
Yeah. Yeah.
Okay, so all I can say is that we've made this work for many years now, and we are probably one of the biggest single foreign exchange earners for the country. And their government understands that they need Blanket to continue producing gold and selling gold to get that foreign exchange. So it's a symbiotic relationship which we don't need to explain to the authorities.
Oh, that's great. That's much appreciated.
Thank you.
Thank you.
And I don't currently have any callers in the question queue, but I'll give another reminder and one more chance for questions to come in. It is star one on your telephone keypad if you do wish to submit a question now. That's star one. And it appears that that's all the audience questions we'll have for today. So, Steve, I'll pass it back to you.
Thank you, Dan. Yes, and thank you everyone for participating. I hope you enjoyed the presentation. As I've said before, the graphic presentation is on the website, and there's also a video presentation where Mark and I go into more detail, and that's also on the website. So please, if you've got an interest, go and have a look at those. But thank you once again for joining, and good afternoon, good night, good morning, and until next time. Thank you. Bye-bye.
Thank you all for joining today's conference. You may now disconnect your lines. Hosts, please remain connected.